Welcome back, and excuse me. In fact, all of the focus this afternoon, as well as in the day of trade today, is with regard to IT. And let me bring on board Christy Mathai, who's fund manager equity at Quantum AMC, joining us this afternoon. Christy, let me first start off by understanding your take on IT. How much of the business model of some of these companies are redundant? How large is the risk? Because what we've seen is now, in the last maybe 4 to 5 trading sessions, we've seen 2 of those trading sessions where IT has fallen over 3%. And that's not very common, right? These large cap IT names do that.
Right. Yeah. Thanks for having me. Good afternoon.
Good afternoon.
So clearly, if you were to just look at what has been happening globally, first I'll like to answer it in 2 parts. One, of course, is the sentiment. And, there is a clear global sentiment where hardware spend has been prioritized because, that is what the need is at the moment, more at data centers, more processors, etc. So globally, if you were to just look at the sentiments, towards the hardware segment has been pretty positive, and that's what has been resulted in some of the profit metrics, stock price performance of the companies like Nvidia. You have the DRAM and the NAND in Korea. You have the processors, foundries, etc. in Taiwan. So they have done pretty well because the incremental allocation by most of the enterprises have been towards that. And the software bit, which includes the SaaS companies, have been sort of underperforming for some time, and more the YTD they have been hit hard. And IT services is typically the implementation of these softwares in a very customized fashion in some of these enterprises. That's where how the whole things is stacked up. So clearly, the hardware spend has been prioritized as against this, and to our minds, some of these spends. If you were a global manager and looking where the EPS growth is in the next 1 or 2 years, possibly 1 year at least, looks like the capex spend has been more prioritized, and some of these stocks have done well and the others have not. But if you were to just look at the earnings growth or the revenue growth from some of these SaaS companies, they are just about where it is. It is not commensurately down. It is just the sentiment which is being rubbed off on some of these SaaS and whereby IT services, and that is what is reflected in the Indian context, also in the Indian services. Now, can this change? So one possibility is you have to showcase higher adoption of AI from some of these SaaS players as well as Indian players. Now, in an enterprise context, that is not really happening. Even if you were to look at the Fortune 500 companies, they're also a bit slow in this adoption, but slowly it will trickle in. And our expectation is when that happens, some of these services players also should witness increased volume. Now, one can debate about the rationalization and pricing. That can very well happen. There could be upfront cost, which, pricing discussions, which one would have to give. But over a period of time, our belief is it'll be more volumes for the IT services, which would help. Near term, there could be some pain because clearly the sentiments is not in the right direction.
I appreciate that view. Hi, afternoon. Good to be chatting with you. Now, very interestingly, Christy, I remember our conversation back in October, wherein you said that stocks look very reasonably valued, given the kind of
Right.
shedding that we've seen right now. That valuation, one might assume that it looks more attractive now at a time like this to you. Fundamentally, when earnings have not been all that bad and the valuations have further shaved off, do you believe it's a very good time to buy IT now, only on the back of both of these factors?
Yeah, one would have to look at their allocations clearly. We are allocated to the sector, and clearly the valuations have come off. There was a bit of rally, but the past few days things have turned the other way. See, fundamentally, what has changed, if you were to just look at the 2 quarter of growth, at least by the global major IT services players or the Indian IT service vendors, they have showcased an improvement in the earnings trajectory. You have seen fair bit of growth coming in, in BFSI, and also some part of discretionary growth also coming in. Some of them have started reporting the AI sort of revenues that is through. I don't know how long it will hold because in a way over a period of time it'll get subsumed in all their offerings. So this is very similar to what you have in the 2016-17, tech migration, where it was SMAC, social mobility analytics cloud. If you remember, so there was this transition pain that was there, but eventually things sort of moved in when, it was adopted enterprise wise. So far that has not been there. That is the concern. But so from our lens, the valuations have become more cheaper, and you have had a fair bit of earnings uptick in most of these names. The order books are looking fine. Some of the large verticals are turning. So we are hopeful in the sector at the juncture.
Okay, Christy, let me shift focus. Consumption is the other big theme that's playing out, and I know a lot of those consumption-led individual players have already started to re-rate. For example, auto over the last few months has re-rated very, very sharply. Again, this week we've seen a decent move with regard to where auto is concerned. The numbers have been strong. Where else within consumption is there a profit pool emerging, in your opinion? And there is significant value left on the table in terms of opportunity at this time to buy.
Right. Uh, so yeah, auto was a clear, we had larger allocations to that sector. Over time, we have been trimming because some of the segments we think, the valuations have caught up, to long-term averages, or fundamentals are uh, clearly reflecting where. So there is no cheap pocket within that. We are hopeful of the mass end consumption within this auto pack. That should happen because, some of these names, especially the two-wheelers, we are seeing the affordability with the GST cut coming in after a long time, and the income growth has been okay. So there could be possibly a longer, volume uptick that you can see in some of these pockets, but by and large, the others are fairly valued in our view within that pack. The other large segment we think is the consumer durable play, which have been languishing for some time. Especially, there have been significant drawdowns that has happened, in some of these pockets, owing to seasonality, some bit of competition. So, with the rising incomes and, now possibility of a decent summer going ahead, some of these pockets can look attractive in our view. So we have sort of added to some of these names, in the, let's say, about a quarter or so. So that is the larger allocation to us from this whole consumption bucket apart from autos.
And shifting focus away from consumption and auto, Christy, let's talk about capital goods, energy, and healthcare. Some of the laggards in the month gone by. What is the outlook on some of these sectors? And do you believe the next earnings season, that's the quarter four numbers, or perhaps even the next financial year, could see a pickup for some of these names?
Yeah, so capital goods, again, a lot of that is linked to power sector. As you can see, the last year things were not so great. Again, seasonality was a factor, but also to my mind, there's fair bit of overcapacity at some point in time. You have seen some of the deferrals in some of the order books for some of these names. And my sense is if the demand, which was fairly strong few years back, is not to that tune this year, you can see again, some of these challenges repeating. So, but our concern in that whole pocket is the valuations because, we used to have one of those names within the cap goods we sold out some time back, but the valuation to our minds are not, in the fair zone. So that is a key constraint. The earnings uptick can happen from last year. It's a question of whether you are willing to pay for that earnings, at current juncture. Some of the other sectors like energy, a lot, we have some allocations towards the utility names within these, which could benefit, if the input prices goes down, you would see fair bit of that. So that is how we are placed, on the upstream and the downstream within the energy. It is more a play on how the crude would react at the juncture. Looks like that is moving up. So it could be a headwind to some of the OMCs in our view.
Okay. Christy, I wonder if there are, and I want to try and understand more from a macro perspective. For a long period of time, there's a cohort of analysts which believe that the large cap index and fund managers, of course, where large cap index will likely outperform the mid and small. Does that significantly change given the kind of flat nature of both the mid and the small cap indices, even though we've seen a bit of outperformance in recent weeks? But does that thesis change for 2026 for you at least?
Yeah, so again, it's a bit difficult to call because we have seen a fair bit of drawdowns within the broader segments, that is small cap. So there are individual opportunities within that. And actually, if you were to just look at our portfolio tilt, of late, it has been finding opportunities within that small mid segments because, the index would have fallen, let's say 5, but the drawdowns in some of these names are much higher. So we have added to some of them. So there are those, but see, one of the factors that at least from a macro point that has happened well for the country is, culmination of some of these deals, especially with US. So we were a fair bit worried in the with respect to currency for the INR USD for some time. Now looks like some of those challenges are out of our way with this deal. So if if I was supposed to come back, which in my view may not happen in the immediate trajectory because you just compare the EPS of some of these other emerging markets. India looks like a it is behind, though it is consistent at about 13-14%. So if they were to come back, it would be possibly large cap which can move up. But outside of that, there is no clear segmentation or one picking at this point in time. There are enough opportunities also in the broader segment given the correction.
Okay, on that note, Christy, stay on with us. Lots more to talk about and a lot of other sectors to decode as well. But we need to slip into a time-bound commercial. We'll talk to you and continue this conversation on the other side. So viewers, stay tuned and we'll be right back. Back with closing trades, and before the break, we were in conversation with Mr. Christy Mathai, the fund manager of equity at Quantum AMC. So let's keep that conversation going. Christy, thanks so much for staying back with us. Talk to us about your view on defense, a sector that we have been speaking about quite frequently ever since the capex hike in the budget was announced. We've got HAL numbers some time ago. They seem like a good set of numbers, although the company has flagged off some issues that may be visible in Q4. But overall, without getting into a stock-specific view, overall, give us a sense of how you are viewing the defense space, especially in light of the announcements made in the budget.
Yeah, clearly, budget, it is heartening to see, the capex spend, broadly continuing to track the nominal GDP growth and broadly defense being possibly higher within this. So, from our point of view, see, the sector clearly has certain tailwinds given what's happening globally and, India also prioritizing its spends. But our chief concern comes, primarily from the fact of high valuations and also the fact that, this would broadly track your GDP, how the balance sheet of the country moves. And most of these projects are sort of given in a nomination basis. And at this point in time, we don't think there is material margin of safety given the return ratio some of these companies enjoy. And so our thing is like, if you were to just compare it to certain other sectors, mostly PSU undertakings, so there is a clearly defined ROE matrix which falls in place for some of these nomination, projects or which could come through. So to that extent, we see a risk to ROEs and margins. Possibly that can happen, but this is a long-term view. In the immediate, given the immediate thrust that you have had. So see, these order books continue to swell up. There could be some here and there execution challenges. But given the macro backdrop that I just spoke about and the valuations, we have largely stayed away from the sector.
Okay. Christy, thank you so much for joining us. We'll let you go on that note. Of course, on a day when HUL's numbers have actually come out and it reported its Q3 earnings, Snehi obviously caught up with